and has a significant background now actually on the investment side. And then he's recently moved up to the association because he has some great experience with the CFA Institute. He actually funded their continuing education program there. He was part of their editor for the CFA Digest. And he's bringing all that knowledge. And we are transitioning our association to be much more well-rounded and much more education towards the consumers and advisors. It's my pleasure to welcome you, Darwin Baston.
Thank you, Wesley. It is a pleasure to have you all here today with us. As you said, this is something new for us. Last spring, the consumer advocate for the financial planning group spoke at our conference in Washington, D.C. And it was really interesting because what she said to us was, we don't know much about your business. We don't know much about life settlements. But we're willing to try to figure out what's going on with you because our, 69,000, whatever it is, certified financial planners, ought to know what to do on behalf of their clients with regards to their life insurance. So I took a trip to Washington and I spoke with the CFP board, and the first thing they said was, how can we help? So we have tried to open up a cooperative effort where we could have a forum like this. This is the first one. My great hope is that by the time we do this next year, we might have 150 or 200 people there. Maybe we'll see. The other privilege I had was to speak with Harold Davinsky, who I understand is some sort of a Warren Buffett to investing to financial planning. And we had a great conversation because he told me when we first began to talk, he said, there was a time when I was not very friendly to the idea of annuities. I just didn't think they were appropriate at all. But someone over time convinced me that's probably a good thing. And then I had the same view about reverse mortgages. And I didn't think that there was any appropriate thing going on about reverse mortgages. So, but you know what? Somebody convinced me that I should change my mind about that. And he said, I have. And reverse mortgages is very much a part of the whole curriculum and learning process for financial advisors. And he said, I do know a fair amount about life settlements. And I've heard a lot of negative things about life settlements, but you can probably convince me that I should change my mind. And so this is a beginning point for us to be more involved with the entire financial planning network and how we might be of help so that you can be a better help to your particular clients. The Life Insurance Settlement Association was founded in 1994, so we're 20 years old this year. Our spring and fall conference were the 20th anniversary meetings for our members and the outside folks to get together. Our members include firms. We're not an individual membership organization, but they include firms, and we have about 85 member firms, and they serve all the different aspects of the life settlement industry, from life settlement brokers, life settlement providers. We have institutional investors who are members, and life settlement service providers who are people like attorneys and life expectancy and medical underwriters and trustees and escrow agents and those types of organizations. They constitute the entirety of what our association is about. So what we really are is the secondary market for life insurance. All of our members together and collectively create this secondary market as a place where people who have life insurance policies that they may no longer need, want, or can afford can do something about them. And I'll explain exactly why that is. So our goal and our role is to provide a credible marketplace whereby your clients can sell their life insurance policy with trust and credibility and know that they received a value for this asset they have that they ordinarily would not have. You know the reality of the senior population as well as anybody. We could probably, stand up here and quote statistics all day and make them sound however we feel like we need to for the individual purpose here. But the fact is, now the unknown costs of health care is a very scary thing. And I can tell you that hits home with reality to me because I am a senior. I'm 74 years old. Somebody tried to convince me up on the stage yesterday that I had a face age of 60, but let's not fool anybody. I'm 74, so I am a senior. Some days I feel like I'm 95, but that's okay. So I feel like we can kind of identify and put ourselves in the place of your clients and what they want and need to know. But a very interesting report came out not very long ago that 61% of seniors fear running out of money more than they fear dying. That's amazing. Except when you're a senior. Why do I keep working? Because I keep checking my financial plan and say, well, one more year might help. Because there's nothing that I fear more about than being old and being broke, unless it's being old and sick and broke. So that is a reality. So we're all trying to find a way to serve them better. 55% of seniors have lapsed in insurance policy. I'm doing some work with someone else, and we're going to publish a paper very soon, but we've done some analysis about lapsed policies. And what we're discovering is that there is somewhere probably north of, I'll say 40 to 50, $1 billion of face value of life insurance policies that are lapsed each year. They're lapsed each year by seniors. We have a breakdown by age groups, 65 to 70, 70 to 75, and on up. That is a lot of financial resources that could be available to them that I was going to put a slide up here, and I decided I probably should not. It's basically a trash can, and it's overrunning with money. But so the implication basically is that this is money that they're throwing in the trash can, but the trash can is really representing the carriers because it's going back to them rather than in the pockets to help the seniors. 90% of those seniors in the study said that if they had been aware of a life settlement, that they could sell the policy, they would have considered it. Now, that doesn't mean they all would have been able to sell it, but at least they would have been able to make a consideration of what they might be able to do with it. And here's another, fact that we found out with regards to the advisor world, and that is that 49% of advisors cite that they have a lack of knowledge about life settlements and selling life insurance policy, and therefore they don't recommend it to a client. Well, that makes sense. But yet, 79% of the clients of those people feel that an advisor should inform them about a life settlement. So these statistics, this conclusion we're making here, the only message there is we should do everything that we could do to educate ourselves about the possibility that this asset they have might be used for some value during their retirement years. Here's what we hope to do today for you. First of all, I want you to understand that this is a dialogue. This is a discussion between us all. There are some other people in here from the life settlement industry, but we want this to be a dialogue and discussion with you all about what this is all about. And we would like for you to say, stop, wait a minute. If you don't understand something, or if you feel like we're presenting something that is out here someplace that we may understand, that you may not. Because it is a little difficult. We have to put ourselves in your place thinking, well, gee, I don't know anything about this, so help me understand what it is, rather than us thinking, oh, you know what it is already, I'm just reinforcing something you already know. So please, it's a dialogue, say, stop, I need to understand something, so that we can just have this talk together. I want to define for you what a life settlement is, if I haven't already done so. When you might consider a life settlement for your client, a profile of a qualifying insured. We're going to talk a lot about the life settlement transaction. There's going to be a number of people who are going to go through that with you. Some of it might seem like a repeat. So if you still don't understand it, please stop us so that we can. We want you to understand that this is a very well-regulated market. It's as well-regulated, and some of us say, even more regulated in the insurance industry itself in some manners and some parts of it. And the implications of a life settlement, and what do you need to do? How can we help you further? First of all, why is a life settlement even possible? In 1911, the Supreme Court made a decision that a life insurance policy was personal property. That was a huge ordeal. It's personal property. Now, you can do with it, as the owner of that life insurance policy, whatever you feel like you want to do with it, or whatever you do need to do with it. The decision is in your hands, not in the hands of the life company from which you bought it. So here's how my investment background, and for a number of years I had a small investment firm as well, and I dealt with people who were close to retirement age. A life insurance policy all of a sudden, to me, did not become just something that I had laying in the drawer, that if something happened to me, it left some funds if I died unexpectedly at the wrong time for my family. Now all of a sudden, that life insurance policy became an investment to me. Every year I have to pay the premiums. I'm making an additional investment every single year for this death benefit that will be paid in case something happens to me. So I now consider that an investment, and I put it in the same category as in the portfolio as all of the other investments that the folks had. Sure, they had an investment, or they had some benefits they were going to get from a pension fund at some point in time. They had stocks, they had bonds, they had real estate, they had whatever they had. All of a sudden, in the early days that I was involved in the financial planning work for clients, it was like, oh, by the way, do you have a life insurance policy? Yeah, well, okay, well, you're covered in case something happens. Now it became an investment that may have value at some point in time, and I needed to know what that value might be and when that might happen. So essentially, it gives you a choice. Now I had a choice because it was personal property with regards to that. So the seller receives a cash payment, and the institutional buyer, or the buyer of that life insurance policy, they pay all future premiums, and they get the death benefit when the insured passes away. So you're exchanging cash now for no longer having to pay the premiums, and then the death benefit that you would have received at the time. I want to make one distinction up front. This course that we're talking about today and this discussion is really about someone selling their life insurance policy. We're not here today to talk to you about investing in life insurance policies. There is a whole huge market out there about investing in life insurance policies by individuals. That's not what we're talking about here today. So we're talking about seniors selling their life insurance policy not seniors making an investment in life insurance policies of someone else. A lot of reasons why all of a sudden someone takes a look at their life insurance policy and more with regards to older seniors. And I understand that and I feel this myself. Well, I should say I will feel it at some point in time. I think people go through a tremendous emotional change when they move from working and making money and adding to their financial portfolio or value than they do the day they quit working and have to start living off of all of it. And the reason I say that, I have a brother who I'm extremely close to. We make telephone calls back and forth at least every week, and we have for years and years. And he retired 3 years ago. I thought he was really lucky, but after a while he says, you know, you can only fish so long, you can only play so much golf, and all of a sudden you need to find something to do. And I empathize that. He said, just keep working, Darwin, just keep working. But he's, you know, and he calls me up and he says, you know, I was doing a little part-time work here and there, and I haven't been able to do it this summer. And it's almost like he's in a panic. It's like, I need to be making some money. I need to be doing something, generating some income. So it is true, once you retire and you start living off your investments, you begin to have a different emotional feel about it. And when that premium payment comes, you say, gosh, I got to make that one more time. Now, what's the trade-off going to be here? So you might find yourself in a position where you just simply feel like, you know, these premiums are too expensive. And the policy may have underperformed. Well, you know, I think a lot of individuals who don't understand, like you all understand on their behalf, what an underperforming life insurance policy is about. You know, I think a lot of that has to do with the amount of cash it builds up internally and with the very low interest rates for a long period of time and all that. That gets to be confusing, but I don't know that they really understand that probably as much as you do acting on their behalf. And simply, it's going to be a choice for some. You know, should I pay the life insurance premiums, or should I buy my meds, or should I do something else? You know, so there are choices for some to make. I did put a couple of real world examples in here. There are some examples that we have. You're going to hear other real world examples that people will show you today, and ask questions about them. With regards to life insurance policies that were available and they were sold for whatever reason rather than lapsing the policy. So they will go through that for you. Or your needs have changed. You know, I think it's really interesting because, you know, when I was younger, I went through a couple of stages where I put 100% of my money in stocks. And not only that, I put 100% of my money in tech stocks, and 2000, that wasn't that long ago, in 2000 when the nightmare came, and all of a sudden you found that your portfolio value was $50,000 rather than $250,000, and once you sold it, you were never going to recoup. It just wasn't going to happen. So then when you stop and think about it, a life insurance policy is only an instrument. You buy it for some purpose. I personally think that life insurance is sold, it's not bought. I didn't know what I was buying, but I know what somebody was trying to sell me. Hey, yeah, well, sounds good. I trust you. Okay, we'll just buy this policy. And the longer you have it, the later time gets, it's like, wait a minute, does this really satisfy the needs now for the time that I bought it? I mean, I know I've lapsed a couple, 3 policies just because I didn't feel like I needed it anymore. So things change. Things change. Families change. Your spouse may pass away, and you don't need that coverage for that purpose anymore. Divorce, all kinds of things. Liquidity needs are a huge one. So you need to evaluate exactly what is the purpose for which this policy was bought, just like why did I buy these bonds, or why did I buy this stock, or should I change that for whatever reason. So now you know that you may be able to do something as well. Here was just another real-world example of individual owned 2 survivor policies. And, here again, I think some folks are going to go through and have a really good discussion with you about real life examples in their presentations as well. There's a lot of question about who qualifies for a life insurance policy. And if you were to go online and look at a lot of companies who are in this business, you'll see their criteria, and it'll change a lot. I think what they're really all trying to do is bring the attention to you all that at some point in time, if people have these characteristics, they may qualify for a life insurance policy. But stop and think about this and ask questions about it when the speaker comes up to talk about valuations too. Life insurance policies don't have much value for people. I might use the wrong term here. Should I use 65 or 70? Let's just say 65 or 70. And the reason is this is a mathematical exercise. And somebody will go through it with you very simply. It's a math game, and it has to work out. If I'm buying your policy from you, I have to pay the premiums. So therefore, I got to know how long I'm going to have to pay those premiums, and then about when I'm going to receive approximately that death benefit value, based upon the fact that I want to earn this certain return. So you have to work all that out. Now, I know there's some other things that people are experienced and can get deeper into those things that create that value. But essentially, so if you're not 70 years old and older, somebody tried to convince me that I might live to age 90, and if I'm 70, well, I'm not sure you're going to be able to afford to pay, the investor's going to be able to pay premiums for 20 years to get, and then wait for the death benefit that long. So it's basically trying to work out how long that period of time is going to be. How long that period of time is going to be is probably one of the most important factors. So health impairments and the measurement of those health impairments and what impact it may have on how long you're going to live are important issues. Types of policies, people have asked that, so I'll put that right up front for you to think about. Whole life policies. Let me define this first. A life settlement can be done as long as the selling price of the policy exceeds the cash surrender value. Otherwise, why would you sell it? But that amount will also be less than the death benefit. I guess that's so commonsensical but we'll say that anyway. So somewhere in between all of that, is so universal life policies. I read an interesting thing about universal life policies in the last few days that credited amounts into universal life policies are very, very low because interest rates are so low for such a long period of time that the insurance companies aren't earning enough money on it to make the kind of credits into the policies that they thought. So a lot of people get surprised as to the value that policy may have than when they originally had bought it. Because anything that you are given when you buy a life insurance policy is nothing but guesstimates. They're all guesstimates. So how much future premiums you're going to have to pay and all that, and those things change. But universal life policies, universal variable life policies, whole term policies, and term policies. Now, why would a term policy be worth anything? I know there are at least 3 people here could explain this a whole lot better than I could to you, but I think the thing is, term policies are convertible. Many of them are convertible. So if you convert that, and I think then the premiums are real low on those, right? So therefore, they become attractive for life settlement. So because a lot of people have this perception, why would you ever buy a life settlement? It's a 10-year term policy, and we're 6 years into it, and you're going to buy this thing because it must be they're going to die in a short period of time. But they're convertible for something else. So basically all the range of life insurance policies could possibly qualify for a life settlement. I tried to put just a basic slide together to begin with that showed who all the different participants were in the process of selling a policy. You start out with a consumer policy owner, then there may be an insurance agent or financial advisor as a part of that, and then a life insurance or a life settlement broker, and then a provider, and ultimately it gets to the investor. I did see another interesting statistic one time that a survey that 60% of the people who ever bought a life insurance policy had no interest in never talking to their agent again. And a lot of them don't know who they were anyway. And I think what that points out is the importance that you all play then in that process, because you become the trusted advisor on behalf of your client. So the rest of these can play or will play some role in this process for you. This will make sense as the day goes on, that you start out with some kind of an application. There has to be some sort of an underwriting done. Medical information has to be gathered. That's evaluated. Someone has to do some analysis of whether or not that policy, what it may be worth. It may be put out to numerous people to be bid on. And then ultimately there's an offer. And whether or not if ultimately then there's an acceptance of that offer. And then there has to be the transaction's closed. And then there has to be something else happen, because there's a notification of the insurance company that this has changed, and now there's a new change of ownership. And as you can possibly imagine, no investor is going to release funds until such time as they've received notice back from the insurance carriers that they are now the accepted owner of the insurance policy. So that still has to kind of go on, and then there's ultimately a transfer of funds. I've been asked a number of times how long that process takes, and some practitioners today are going to be able to tell you what that is. I think it could range. I don't know what the normal is, but I don't know what normal is anyway. So it could range from a couple of months. It could be stretched out as long as maybe 5 or 6 months. But very interestingly, we have a speaker that's going to talk here about reverse mortgages. And it takes, I understand, it could take as much as 2 and 3 or 4 months to close a reverse mortgage for whatever reason as well. So the transaction takes some time, and I think you need to manage expectations on clients' behalf up front. Because here I am, I'm 75 years old, I'm far away from it, I don't know much about it anyway, and I've indicated I have this piece of paper laying on my desk that I'd be willing to, the document laying on my desk, I'm willing to sell. Okay, you're my trusted advisor, you get in touch with the life settlement people, and you're going to make this happen. You're going to make this happen. What's happening? So as months go by, I think sometimes you can get really, they can get really depressed about what's wrong. And even to the point, well, I don't even have any interest in that anymore. It's so fouled up and taking so long. The fact is, if you manage those expectations on the front end, and they know everything that has to be done in the process that goes through, then they can understand it better about why it's happening and when it might happen. Our regulations, I think we need to be very, we are very proud of the fact that our market is well regulated. We're regulated in 42 states of the U.S. and plus Puerto Rico. It covers about 90% of the population that would probably qualify for life settlement. It's sort of that diminishing returns, how much effort and all would it take to do the other 8 states. They'll come along in due course to become regulated as well, but there are states who may not have that many people who qualify for life settlement anyway. All states bar the sale of a life insurance policy has been in effect less than 2 years. So it has to be beyond the contestability period before it can be sold. Then back up to the Medicaid. The last 2 years, 2 states have passed legislation, it's writing the regulations now, that a life policy may be used in a Medicaid situation. So when someone has to pay down all of their assets or dispose of all their assets, I think in most cases they're allowed to keep $2,000 worth of life insurance. Those states have put regulations into effect that allow that policy then to still be sold without penalizing anyone. The benefits go into some sort of a fund and used to pay the expenses up to a point, and then when that's exhausted, then they get back qualified for Medicaid. So that is very positive, I believe, and I believe there are 4 more states that have that on their agendas this year to put forward. So that'll kind of gain a momentum. 6 states have some type of a consumer protection, we call it consumer protection legislation. In other words, the life carriers are required to notify their insureds after they're a certain age, what is it, 60 or 65, somewhere in there. Anyway, when they reach a certain age, that if they're going to lapse a policy, they have to be notified what their options are. One of those options is a life settlement. There's a case going on in California right now where someone wasn't given the proper notification, or at least they feel like they weren't given the proper notification, and they chose to reduce the death benefit significantly so they could get the premium payments down lower, and they felt like they didn't receive the proper notification, so they're suing the insurance company because they hadn't been properly notified. So, and our association is very, very, very much behind in trying to get that consumer protection where they must be notified of a life settlement option. In fact, what we want to try to achieve is even at a point where maybe when a life insurance policy is sold to somebody, they would say, one day you have these options available with you, one day it might be able to be sold. But at least before they lapse it, to sell it. So anyway, there are certainly benefits to the consumer for a life settlement, relief of the premium. They get the cash. They can use it for whatever they want to. And I would like to just clarify what I believe is a misnomer out there, and that is there may be certain costs or what we might call penalties to someone who sells their life insurance policy. It means they may not qualify for more insurance. In other words, they've used up their insurable capacity. I'm not in this every day. I have not heard an instance that has been given to me whereby someone who was denied additional insurance just because they had already sold the policy before. I've never heard of that. In fact, I've seen, $5, $10 million policies, and somebody sells it, and then they apply for another, $10 million. I just don't believe that anybody is denied because that is a cost to them. There is probably could be some impact on receiving government aid by selling a life insurance policy. And the proceeds can be subject to creditors' claims, but most importantly, I think that one should know that there are tax implications to selling a life insurance policy, and some of the folks are going to mention that more today. And Bill.
On the insurance companies are prohibited from selling you more insurance to make you worth more dead than you are alive. Most people do not have that problem, but if someone had bought a lot of insurance and they sold it and went to apply, the insurance company can say, no, there's too much on your life, because they can get sued if they overinsure you.
Okay, great point.
So you may have had a lot of net worth originally, and now your net worth has dropped. You sold your policy thinking you could get more, and you can't because you're over capacity. That's the only time it happens.
Okay. Thanks very much for clarifying that.
You're not going to overinsure you.
Just go
Sure.
to the next company if one turns down.
You can do it.
It's called shopping, huh? Shop
You
around.
really should. They will ask you how much. They can do a search to find out how much you have.
Sure.
But that's
Yeah.
the only time it happens.
Yeah, okay, great. But there are tax implications, and someone is going to explain those as well. So, but here is some things I would like for you all to think about. I think it's really critical to seek professional advice. By professional advice, as far as I'm concerned, people who belong to the Life Insurance Settlement Association are great advisors for you to use. Don't just go out there randomly on your own and say, well, I'm going to just shop this around and I'm going to act in the best interest of your clients. We will promise that we continue in our efforts and programs and articles and CE courses and whatnot, and working with the CFP to provide as much education and information that we can. So it's like I said, we're in hopes that next year there are 150 people sitting in here, trying to learn about it. And we believe that our connections with the CFP are very, very positive. So you'll see some articles written. We can do webinars. We can do a lot of things to try to work together, because all we're really trying to do, and our passion is that no senior, especially senior clients that you have, allows a policy to lapse without at least being aware and understanding that it may have a lot of value to them if they were to sell it. Make sure all the parties are licensed, because people that belong to our association and people in this business need to be licensed when you do it. So if you're sure that they're licensed, recognize that this business is regulated by the states, just like the life insurance industry is. So different states have different rules and regulations, and that's why the advice is so valuable and important to you.
Usually licensed with the piece they're doing, too, the actual part that they're playing, not some other part.
Right.
What do you mean?
Like if they're a broker trying to buy your policy, brokers are not licensed to buy policy.
Okay. The different providers and brokers will go through that today for you as well. And then there's a lot of disclosures that are required, and that's why if you use expert advice and get it, then you'll know that you end up getting that part of it right. Is the 000 up here mean that time's up? It doesn't. I never said it, did I? How much time is there left? How much? 20 minutes. Ooh. Okay. I don't just start nodding off here. The Life Insurance Settlement Association this past year started another membership category. Our membership requirements were that people who were full-time involved in the life settlement industry, belonged to the association, and frankly, those dues are like $7,000 a year, because they're firms and they're all involved in it. So we decided that might be a good idea if we can create another associate membership by which people who are not involved in it full-time, or people like yourselves, could become members of the Life Insurance Settlement Association as an associate, enjoy the benefits, information, and all that our regular members do, and with the restriction that you don't get to vote. But that membership is $300 per quarter. I said $7,000 a year. I should say $1,200 a year, but it's $300 per quarter, and I think that could be very valuable to you. So you should, you might want to give that some consideration. And I would like to open it to dialogue and questions. We have a number of people here that are in the business. Bill has made some comments. Brian is. John is there. So let's open it up for discussion and dialogue with you all.
So how are carriers responding to this program?
I think why don't we have some of those folks, and then I can give an answer from the overall association point of view, but what are some of your thoughts and experiences?
I'll share. And we're a nationally licensed broker, so we're aligned with producers, advisors, and the consumer. There's some that are very much open to it, and we'll work with their distribution. They understand that this is not the market of 10 to 20 years ago that was unregulated. They understand where we are today, that the association has been very deliberate in how we educate and work with professionals nationally. So those that take the time to really do some due diligence, they get it. Those that are working on old information. Sorry. Sure. So for those that are taking the time to do the due diligence, they're open to this and they understand it. Those that are working off old information, bad facts, maybe they're confusing what we do with some of the nonsense that occurred, 5 to 7 years ago in this industry, those aren't always as apt to collaborate with us. But as a whole, they understand that no matter what, this is good for the consumer, and it's very difficult to look someone in the eye who's had the .com, the real estate, equity markets, on and on, booms and busts, and tell them that life insurance, this life insurance policy is not an asset that they can do with what they please. And if it helps them fund the lifestyle, caregiving needs, just really that overall independence that everyone wants, it's a very difficult fight for them to say. That's why, although we've been a developing industry, we're still here, we're growing stronger, and professionals like yourselves are here today because it just makes sense.
One of the things, for example, you can imagine, life insurance companies may not like this business because policies don't lapse. Once they're sold to someone, that policy is not going to lapse.
Right.
Now, excuse me. I'll stand back here so it catches it. And there's issues about that as well. If they've priced their products based upon how many policies lapse, then they would like to have policies lapse, rather than do it. But there is a number that we often throw around that I would like to straighten out. We often say 90% of all life insurance policies that were ever issued don't pay a death benefit. They lapse. The thing that we need to be interested in is how many policies lapse from seniors within this age group that may have otherwise have value. That's the important part. I can't give you the exact numbers because I haven't finished the study yet, but I can tell you that somewhere north of $40 to $50 billion a year of face value policies lapse that seniors hold over the age of 65 that may have had some value. So I think that's one of the issues. But if you took that number even and compared that to the total value of policies insurance companies have, it's infinitesimal. It's very small. Bill had a comment.
Yeah, I'm not an insurance broker or anything like that. I'm representing investors. I'm on the buy side. I advise investors, and this obviously is not the advisor I thought I was supposed to be attending. But there was a change in the way we do business. And I forget how long ago, but once upon a time when we do life settlements, we'd always buy it with cash. We'd give the person selling the policy cash. We then start doing another settlement where we rather than buy it with cash, if it's a $10 million policy, we leave the person with $2 million of the death benefit. So we'd buy $8 million, we'd pay the premiums for the entire 10, and when they die, their beneficiaries would get 2. At the time I left my last employer, more than half of our settlements were being done with some sort of benefit left with the remaining beneficiaries. That change in the way life settlements are done radically improved the relationship with the carriers because it took away their ammunition. Because when the person died, their beneficiaries were still getting money. And therefore, it really became a matter of, I can't afford the premium for all 10 million. So we would come in and pay the premium for the 10, and we take 8, they get 7. It improved the position for our investors because there's less cash going out in front. It makes the sellers' interests align with you. The longer they live, the less the value of their policy, so they get their benefit, their $2 million later on. If they die sooner, they get their $2 million earlier. It was a radical improvement in the way we do business in the life settlement marketplace, and I think that helped. In addition to the things that it is good for the consumer, that also helped eliminate a lot of the life carrier resistance.
I wrote an article not very long ago in a blog on Life Health Pro by saying that I didn't understand why the life insurance carriers who sold consumers something wouldn't also want to give them the benefits when they didn't, some kind of benefit, when they no longer needed that product. If you do well by your clients, you do well by the company. But I understand that was just sort of an overall theoretical remark, but I think the total impact on the profitability of life insurance industry in total, because policies are remain to maturity rather than lapsing is, I would say it's immeasurable. I can't prove that in numbers, but we can throw a figure out there at some point in time that says they should be on our side in helping consumers. They should be on your side and you helping your clients as well. So that's, I think Brian had a comment too. Oh yeah, you have a question. Go ahead.
I'm brand new in this industry, so forgive my question. It's kind of simplistic.
There are no,
But who approaches the investor? Does it always goes through a broker, or does the producer sometimes approach the investor? How does that work?
okay, I'll start by making a comment and then we can go on from there. But all life insurance policies that are sold as life settlements must be sold through a licensed provider. Okay, I'll start out by making that comment. The second comment is that relative to some people are extremely knowledgeable and very sophisticated, and they understand all the ramifications, so they may take the life insurance policy and sell it directly to a provider. Others who are not as knowledgeable about it and they need the help in trying to get everything together that they need to do, and then this happens as a bidding process. The life settlement broker can take all the information you need. They can give you an indication whether or not the policy has value, and then they shop it through several brokers to try to get the best price they can on behalf of their client. So it can happen both ways, and you'll hear further discussion about that during the course of the day about that. But if you seek out, if someone's going to use a broker and they seek out a licensed broker, and of course all providers have to be licensed, then you're on firm ground.
So what you have, you can go back to this slide that you had up here earlier. The next one.
Right there?
Yeah. So you see that there's a provider next to the investor. The provider represents the investors. And so and the investors don't have a license to buy anything direct in the States. The provider has the license. So the licensed parties are provider, broker, and in most states, well, I'd say I guess all the states, if I can recall correctly, the insurance agent financial advisor really has to get a broker's license too. So whether you're going to actually act as a wholesale broker who's in it every day or not, you still have to go get a license to be able to. Correct. So really there are three licensed in this particular flow chart. There are three licensed entities: the insurance agent, financial advisor who has to get a broker's license, or their agent's license allows them through producer authority to act as a broker in a settlement in some states, in most states now, in fact, I think. But the provider represents the investor, and those from the wholesale broker back represent the consumer.
So the agent can go directly to the provider.
That's correct.
Yeah, it's possible. It's possible that they can. In most cases, the role, and you'll hear this afternoon when a broker talks, the role of the broker is to act on behalf of the seller of the policy. The role of the provider is to act on behalf of and buy it for either themselves or for an investor. So there's kind of I don't want to use this term fiduciary because there's so much controversy about what's a fiduciary out there, legal or otherwise. But basically speaking, the broker is trying to act in your best interests to shop it around and get the best price they can. The provider is buying it on behalf of some investor. But that, as Brian said, that doesn't mean that the agent or the planner who's sophisticated and understands it enough could go directly to a provider and sell the policy.
So you actually have sometimes the consumer goes directly to providers. They don't use anybody to help them. Sometimes they use their own financial advisor who goes to providers. And sometimes their financial advisor or the consumer chooses to use a wholesale broker to go. So as long as everybody that's on the consumer side represents them as licensed, and then on the other side, the folks are licensed, then you got it covered. Sometimes there's a problem, though, because sometimes people, even today in this market, are not licensed, and they're acting and hold themselves out. You have to look. That's why I made the statement earlier that you need to know that what somebody says that their license is what it really is, and their license, yeah.
Right. We have, John Mendelson in the back is going to give a presentation this afternoon about the broker and the role of the broker and in the part that they play. So, anyway.
I'll add that
Yes.
if you're in this as an advisor, not looking for compensation, you don't have to license.
Justin, repeat that.
If you're in the role of an advisor not looking to be compensated on the funds of a life settlement, you do not have to be licensed. But we all work for free.
I'd be careful with that one, that approach. We're probably more conservative. Well, what they talk about in most state laws is submitting a policy. So if a policy is being submitted to market, you are acting as a broker, whether you receive compensation or not. And that's something to really pay attention to from a compliance perspective. And
Only if it passes through your organization.
and certain states, depending on what it is, or whatever your position is within the, if you're more of a fiduciary minded, not an agent of the carrier, you might have, heightened duties where you need to submit to multiple sources to make sure you actually have the competitive bidding. Because when you look at Darwin's slide up there, it's a really good slide. One way to even illustrate it, just a picture's worth 1,000 words, is if you imagine that's a boardroom and there's a table going straight down the middle vertically. You have those that represent both sides of the party, each party, and they each have their own agenda. So it's important to understand what everyone's agenda is moving into it. And what we're seeing, getting back to the original question with carriers, was that many of them see this as an accommodation because they know they have to serve their client. Others see it as a way to remove the potential excuses or reasons that their clients, that their producers or their advisors are not be able to serve their 40 to 60-year-old clients because their bandwidth is tied up in caring for their loved ones. And if they can remove that pressure of that sandwich generation and caring for their 70, 80, 90-year-old family members, they can then get down and do some real planning.
So here's
just
the
something to think about.
Yeah, so here's the takeaway for you. There are various people who play various roles to help you get your client's policy, one, evaluated, two, whether or not it should be sold or not, three, if it is decided to be sold, here is a process that can happen. So we'll try to keep ourselves understanding from your point of view, but also understand we have a lot of competition with our own industry about that, because our industry went through, a retraction during the financial crisis, just like everyone else's. But we do want you to understand the roles of different people and what's possible and what's not possible. So I believe with that, I just got the high sign that said like that. So you can probably edit that out of the tape at some point in time, I guess. So, okay. 4 minutes yet? Okay. Does anybody else have any questions then?
Not a question, but a comment.
Yes.
I've come to, I used to think that, was it ethical or not, that when you sold a policy, to tell the person, by the way, I could always get you to sell it in the future, was ethical or not, because you're like taking them into a transaction, then pulling them out of it. But I've come to see that one of the best things you could do to a person is advise them from the beginning that if they confront some difficulty in the future where they cannot, or reach an age, or the circumstances change, as we've seen here, they do have the option of a life settlement. I think that's what I've been hearing. I'm being bombarded. The takeaway, like you said, in every one of the classes, is there is this opportunity, and you have to make it available to them, you have to educate them in that sense.
Right. You're right. I mean, that gives us the goal and responsibility that we have to provide that kind of education and that kind of knowledge so that they're getting the best advice that they possibly can.
Well, people know when they buy a home that they have the opportunity to sell it.
Right.
People know that when they buy a car, that they can later sell it. People know when they buy a diamond ring that they can later sell it. But the insurance industry's done a good job over many years of not letting people know that they could sell life insurance. And only since 1989, when this industry really came around because of the advent of HIV and AIDS and began to come into the mainstream, has this become an idea that has begun to be planted in the minds of the consumer. So just like anything, if you buy a stock, as you said earlier, you know you can sell it. So yeah, people should know this, and they don't. Most people don't.
We've even done some, I did a study one time on the comparison of reverse mortgages and a life insurance policy. And, you know, first of all, it was saying, gee, most people think, well, this policy doesn't have any value until I die. And then, you know what, it doesn't have any value to me. It has valuable to the people, the beneficiaries who I said that it had been purchased for. So I went through this whole analysis of a reverse mortgage and what you go through, and then a life insurance policy. And I asked a couple of my kids, about that. Gee, if I sell this life insurance policy, you're not going to get what's in it in terms of beneficiaries. And they said, but I said I do have a choice. I could send you all a bill every month, every quarter, so you could help me pay the premiums, or I could sell the thing and absolutely without hesitation, see if you can sell it. But the issue is that I think with regards to a reverse mortgage, people have a different emotional feeling about their home. I worked hard all my life. I finally paid it off. It's all free and clear. And so I'm going to do a reverse mortgage, and fine, they're going to start sending me checks every month. But I'm all of a sudden going to start getting a statement that said I owe money back on this thing, and it gets greater every month that it goes. And oh, by the way, if one of us moves out of the home, it may have to be sold. And I think emotionally speaking, it's easier for people to part with a life insurance policy laying in the desk than it is with other forms of financial resources possible, for example, like a reverse mortgage. Bill.
Sir, I would say if your one takeaway is that you become clear on the fact that this is a good benefit that people should be advised that, when you fill out your performance reviews, your evaluations that Dawn and Shannon and others who put this conference together have done a superb job. Because that is a great takeaway.
Thank
and
you
for
so
someone
very,
like you
very
to
much.
have that takeaway, that to me says that this is an outstanding conference.
Great. Okay. All right. I think with that, Shannon gave me the second time, so I am through, and I think Wesley, do we take a break now? So we take a break now, and then we'll come back for the next session. Thank you so very, very much for being here.